Hey everybody, welcome to the session. My name is Jose Blasco. We are live. We are about to get started. Before we start, I'd like to have a quick confirmation to make sure that you hear me well. You hear the sound of my voice, you see my screen, the video stream as well, and we are ready to go. So a quick yes, a quick hello on the chat box would be appreciated. Thank you so much, guys. Thank you very much. Pleasure to join you for this webinar to talk about order flow in trading. We're going to talk about the forces that move price. It's critical. It's tremendously important to understand the mechanics of price movement when trading or investing. And often it is not 100% or well understood. And hopefully today is going to be an impactful day for you guys. Looking into it and understanding a bit better how everything works. In any case, let's get started here. So again, my name is Jose Blasco. You can see our email addresses, both mine as well as the support team, tradective@youcantrade.com. And I wanted to take advantage of this intro slide as well to point at the fact that You Can Trade has a mobile app for iPhone. So if you are not using it, it's free to download. Make sure you do, so we can be connected and communicate this way as well. And before we start the session as well, I would like to look at the disclosure. I'm going to maximize it so you can read it. Obviously, this is important information. This presentation is obviously for educational and informational purposes only. And again, all the text I maximize is critical, and it's important for you to read carefully. But basically, what this means is that, in trading, in learning how to trade, which is what we do in our Tradective channel, we are identifying real-time opportunities to be executed. And of course, some of you may execute with larger size, with smaller size, with real capital, with paper money, depending on where you're at in your learning curve. So make sure that all of those are your decisions, okay? And you keep all of this in mind. Very good. So You Can Trade. Today we have our presentation, Introduction to Order Flow. And my name, Jose Blasco. I am a multi-asset trader. I trade everything really. And I also, not only I trade all markets, I also trade different styles. And the reason is very simple. I am a trading lover. I really love trading. But also now getting a bit serious here, everything in life, including trading assets, have pros and cons. So you may say futures is amazing. Yes, but there is a downside. You may say options are amazing. Yes, but there is a downside. You may say stocks are amazing. Yes, but there is a downside. You may say currencies or cryptos are great. Yes, but there is a downside. So everything got pros and cons. So what I do is I surround myself by the assets that provide the greatest benefits for certain styles. Okay, so for example, in the longer term or even intermediate term, I really love to use options. Or if I go all the way to the short term, then my bread and butter is futures. And again, I use all those different markets for those different purposes. Okay, but enough about me. Really, the session is about order flow and about you guys. So let's begin. Okay. Session for today. Okay, so first I'm going to share a few thoughts with you, just so we start thinking. Trading, apart from methods and knowledge and skill and experience, trading has a lot to do as well with the psychology part of it, and therefore the right mindset is important. And I would like to start with a few thoughts as we get into the order flow in trading lecture. The direct and the indirect forces that move price, that's going to be extremely important that you understand the difference in between direct and indirect forces. And by the way we're going to define it, really, you will see that it will apply to all markets, all styles, and also all trading styles, okay? Because I expect that, a portion of the group with us today, many of you probably are trading already, and you trade maybe actively or maybe semi-actively, where others in the group, you may be in learning stages and you have never traded before, or maybe you have, but only paper money. So again, I understand that there may be different groups of students, as well as different styles, as well as some of you trade stocks, some of you trade futures, some of you trade options. So again, we're gonna look at the forces that move price in a way that it applies to all of us, no matter the style, no matter the assets. So it's gonna be very easy to understand, but again, very powerful, and hopefully really opens your eyes, okay? Then we look into applications and examples. Again, lecture time it's important, but really we learn. Sometimes one picture is worth 1,000 words, isn't it? So we're gonna go through examples to understand the concepts of today's session better. Of course, Predictive Channel, we have a thoughtful gift for you to apply it, and you can understand and master the markets more easily. So we'll talk about that later in the session, as well as we'll do Q&A at the end and so on. Okay, good. So let's begin with your thoughts. Question. Okay, and feel free to comment on the chat box. I love the session to be interactive as well. Just to make sure that we are wise using the time, since we got limited time to cover a lot of information. And I tend to speak fast, by the way. So you guys go ahead and type your questions or your answers on the chat box as we go, and I'll be reading you. Okay, I'll be reading you, but really when it comes to providing answers to you guys, probably we'll do that towards the end, so that way I can cover a lot of the material, because sometimes you will have questions for me, and guess what? The answer is coming naturally in the presentation. So when I see that, I will skip your question just because I know the answer is coming, and then at the end, I will go back and make sure that everything has been answered. I will absolutely leave no question unanswered unless I get distracted. And if I do, please copy paste your question again, and for sure I'll be there with you guys. So thoughts. Have you ever entered a trade, saw yourself stopped out of it just to see price begin moving your way right after you have been taken out of the trade? Okay, like there was a webcam on your room and the market was watching you or something like that, right? So again, this may have happened to you. Okay, this may have happened to you. This is a pretty common complaint among traders, okay, especially traders in earlier stages of their trading experience. Have you ever considered looking beyond the bars found in the price charts in order to understand better how the underlying forces that move markets truly work? Okay, so many times we look at a time frame, we see a candlestick formation, for example, or some crossover in some indicator, or there are millions of techniques on how to trade. So pick one. Okay, you look at something on the chart, and next thing you know, you're like, okay, time to take the trade. Okay, but what's happening behind the scenes? That's a little bit of the question that I want to address today, so you understand better that, right? Because often traders execute trades out of visible information, such as the charts, the news reports, which often conflicts with what large market players do, as they always try to hide their true trade size intentions. Okay, this is an important concept. This is a very important concept. If a very large market player places a big order in the market, you can see that, for example, very simplistically by looking at a level 2 screen, for example, or on TradeStation. You can load the matrix, and you would get to see those values there on the matrix, and you would be like, oh, there is a big order there. Okay, right? But is that the real intention, or is not the real intention? That's the question, right? And while an order that shows up on a level 2 screen is a real order, the reality is that market players nowadays, nowadays for a long time, for decades now, since the 90s when the markets became electronic. So they obviously have very advanced trading technology to manage their executions. And it's very common that, I'm just going to go for two extremes. In one hand, a large market player wants to make retail traders feel the market's going to go up or down, and shows very large sizes in tools like that. And when they're about to get filled, they cancel those trades, speed of the light, because they co-locate their execution servers in the same buildings at the exchanges. And actually, they pay very expensive to be closer and closer, a few feet away from the servers from the exchange, connected with fiber optics. And so there is basically very little to no latency to cancel or replace orders. And basically, while those orders are true, because they keep being replaced and canceled, they often confuse people. That's to their advantage, and while retail trader suffers the consequences. Okay, and the opposite is true. So let's say a large institutional player wants to enter a very large trade in any direction, either up or down. It's no way they're gonna just have there an order where they want to purchase, 25,000 contracts of the S&P 500 futures in one trade. They're not gonna do that. They're gonna use iceberg orders and other techniques on how to break it down in random pieces and place it in ways where they try to be invisible. They cannot be invisible, but they try to as much as possible, so people don't notice their true trade size intentions. Okay, so the idea of this session is to open your eyes and help you understand what truly happens behind the scenes, enabling you to improve your trading decisions as you become aware of the two different forces that impact the markets, okay? And again, the two different forces is going to be two categories of forces, okay? And we'll go through examples where we'll look at different types of techniques on how to trade, and you will see how in the end, all of those different techniques, some of those actions will fall into two categories, and those two categories will be relying on those two different type of forces, okay? So let's begin defining what is order flow, okay? So which is the title of the lesson, by the way, right? So order flow refers to the continuous process by which buy and sell order tickets keep coming in and out of a specific market. In other words, as we speak, as we are reunited all together here in the You Can Trade room, so there are people around the world clicking the buy button, and orders to buy travel through the internet, coming to the exchange, as well as we speak, there are people out there in the world clicking the sell button on orders travel through the internet, getting to the exchange. All of this is the order flow, right? All of this is the order flow. Depending on finding a valid counterparty, those orders that arrive to an exchange would either be executed or not. And if they are not executed, because for every buyer, you need a seller that accepts the trade at the same price, or for every seller, you need a buyer that accepts the trade at that same price. So then after a while, these orders may be canceled, and those order tickets did nothing, or these order tickets maybe did a lot, right? So fully executed orders are known as field orders. We call them FOs, and this is just a little bit of terminology so you understand better the lecture coming. Whereas the orders that are still waiting to either be executed or canceled are known as on-field orders, and we call them UFOs, okay, which of course also stands for unknown flying object, but you will see that actually those UFOs, you know, when we then plot them on the chart, they're going to be like flying saucers. They're going to be round circles, okay, and actually it's a good coincidence that UFOs also stands for on-field orders, as you will see, okay. Anyway, so now that we know what is order flow from a very basic point of view, let's begin defining direct and indirect forces as we go deeper into the lecture and into the examples. So a few thoughts to be kept in mind. There are many forces that may impact a market, such as news, reports, fundamentals, technical factors, etc. Okay. Wait, I read you. So markets only move when the trading session is open, and this is because orders can only be executed during market hours. Okay. So again, let's pause here for a minute and let's go back to the prior paragraph. It says here, for example, there are many forces that may impact the market, such as news or reports. Okay. So I want to pick one specific news. Okay, I want to go back in time, and I'm gonna go back in time many years ago. I'm gonna do it on purpose because I want to pick a news that we all agree with. Okay, because again, many times news or reports, like for example, now we got unemployment number, right? So some may be thinking, oh, there is no recession. Some may be thinking, oh, the unemployment numbers are crazy. Some may be thinking, oh, the unemployment number doesn't reflect the reality of what really happens with COVID. So there is a lot of interpretation when it comes to some news, and some people may be right, some people may be wrong. I may be right, I may be wrong. Again, even if I'm right, on top of that, while you know I may have a decent account size to trade, I don't have the power to move the S&P by myself. Is that making sense? This normally retail traders, we use limited size when we trade, isn't it? So I want to point at a news that all of us agree, okay? And there is no need for interpretation. And that's why I want to use that news as an example. So that way, this lecture today is something that you remember forever, okay? Because it's a critical concept, and I want to make sure I make a point, okay? So the news I want to point at is going back in time. I want to point at the tsunami that took place in Japan many years ago, okay? So, of course, first of all, that's a real news, okay? The unemployment number is a real report, but we all know that those numbers are corrected later on. So you can see that in any website that reports economical data, that, then there are corrections. So in other words, not only the numbers are coming with delay, on top of that, the numbers are corrected. So, again, and you need interpretation. So again, I'm not saying it's not relevant, it's very relevant, but let's put it on the side because it's subjective at times. Now, if I point at the tsunami in Japan, it's a real news, it's happening real time, it's not a joke, and there is no need for interpretation. It's a bad news. We all agree when the tsunami in Japan took place, it's a bad news. No one is going to say, oh, yeah, to me, it's a good news. No one is going to say that, right? So that's why I am pointing at that particular news, so you understand my point. So now, with that news in mind, with the tsunami in Japan in mind, so I want to ask you a question, okay? And then I want to ask you a second question afterwards, okay? So the first question is, and feel free to type, is, would you guys say that a news such as the tsunami in Japan that took place a few years ago, would that news have the power to move the market, yes or no? What would you say about that? Is that news big enough to move the market and you know, the Japanese market, even international markets, the Japanese yen, the currency markets? Absolutely, right? It's massive, it's major, okay? And I 100% agree with you, okay? But now I'm about to ask you the second question, okay? And I would like you to read again the second paragraph. Markets only move when the trading session is open, and this is because orders can only be executed during market hours. So let's say we have the tsunami in Japan, where we all agreed this is a major event that could move the market, but let's say that happens over the weekend when the markets are closed. So the question is, how much would the market move over the weekend if the market is closed while the tsunami is happening in the real world, and it's crazy and people are dying, and it's really something that, you know, we could not believe is happening, right? On how big that news is. But how much the market would move over the weekend? Well, it would not. It would not move. And why it would not move? Because the market is closed, orders don't get filled, and therefore there is no price movement. Okay, now of course you are thinking, wait a minute, what about on Monday? Yeah, on Monday for sure. Okay, why? Because on Monday, given the news, on Monday, many orders that were in the market may have been canceled. Many orders that were not in the market may be now added, and the market opens, and the buy orders find the counterparty and buy from the sellers, and the sell orders found the counterparty, and the sellers sold to the buyers, and now you got price movement, okay? So the question here, when we talk about direct versus indirect forces, is what moves the market, okay? What is the direct force? The tsunami or the orders being filled, right? While both are very important, I guess we agreed on this initial portion of the lecture that without the orders being filled, price movement will not take place, and therefore the direct force, okay, are going to be those unfilled orders, okay, becoming filled. While the reason why those orders are there in the first place is the indirect force, which in this case could be the tsunami in Japan. It could be many more things, as we're about to explore. So market moves cannot occur while the market is closed, which is when no orders are being filled. Therefore, a sensible conclusion is that the flow of orders entering a market is the one direct force responsible for the movement of price. All other reasons, which are critical and very irrelevant, such as news, reports, fundamentals, technical factors, all those other reasons would be seen as indirect forces, since their potential influence would translate in price movement only if and when a significant amount of orders change status from unfilled to filled. Again, I guess this slide, it's let's call it common sense. Probably I'm not saying anything you don't know. At the same time, if I was to speak very simplistically and I was to refer to what we used to hear on TV, let's say you are a person, you are very interested in learning how to trade, and because you're attracted by the markets, you follow the news on TV, you follow you know, some TV shows, you know, Jim Cramer, you name it, right? So what happens most of the times? Probably your mindset when it comes to understanding trading would be set on thinking about indirect forces, because on the TV, when you're listening to the news, if you read websites that talk about markets, typically you are being explained kind of like the why things happen, right? So the market is falling down after the very bad unemployment number. The market is going up after the Fed said blah, 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 right? And we are used to that, and therefore our mindset often starts moving in the direction to you know, understand trading and understand the financial markets based on the indirect forces, where while they are very relevant, you know, the direct forces are the ones that truly move price. Okay, so the idea is in today's presentation, we get a deeper understanding of both forces. We understand they are both important, but certainly, I mean, if I was to ask you what is more relevant, direct or indirect, I guess that the word says it all. Direct forces is more relevant because without it, nothing happens. even if you have the indirect, you don't have the direct, right? So again, I want to get deeper into this so we understand this better, okay? Let's dive deeper into indirect forces first. So what are the characteristics of the indirect forces, okay? 1 second here, guys. So what are the characteristics of the indirect forces? So the characteristics are, the indirect forces are the following. So news reports, fundamental, technical factors, etc., are subject to interpretation, where large market players may act on them by adding or removing order tickets from the market. So they are very relevant, but keyword, interpretation, okay? So interpretation is by definition subjective and often puts the smaller market players at risk of being on the wrong side of the market. Furthermore, large market players often have access to this type of information ahead of smaller market players, adding even more disadvantages to the latter. A classical tool that fund managers use, for example, is to have Bloomberg terminals, okay? So a Bloomberg terminal is a tool that gives you access to real-time market news. This is one of the features. There are many other features, but this is one of the features. But depending on how you could acquire and subscribe to such tool, to have a Bloomberg terminal normally costs around, let's call it $10,000 a month. So obviously, this is a powerful tool, but obviously, this is in the case of, I would say 99.9% of retail investors, I would say it's way too pricey, and therefore retail investors don't use those tools. So how do they have access to market information? Well, typically websites. And what happens with the websites? Well, the information is there, but it may come in there 10 seconds after the report. Maybe it's 15 seconds, maybe it's 1 minute, maybe it's 5 seconds. But in the world of computer trading, 10 seconds is an eternity. So large market players can access that information slightly ahead of time. And obviously they have the size, and the size moves the markets, and therefore they can play all sorts of games and basically get the public a bit confused in a subjective territory where now they have to interpret the news and what's already happening, because when they get to see the news, something is already happening. So they may even be late to the party already while the news is being reported, okay? Removing order tickets, Anna, can happen anytime, actually. Even adding order tickets can happen anytime. You could place orders and cancel orders over the weekend. Not a problem. But they will not get filled unless the market is open and trading, okay? So indirect forces are indeed powerful reasons for the markets to move, but it is often problematic to plan trades exclusively based on this type of information, as the outcome often lacks consistency, okay? So let's take a look at example number 1. Enough about slides and text. Let's begin looking at charts. And by the way, I'm going to have a collection of examples where I will use currencies. And I love to use currencies in the examples because it doesn't matter what you trade. In the end, everything you trade is a currency. So if you trade stocks and the price of the stock is 180, it's $180, and that's a currency. If you trade futures and you trade the S&P and it's 3,000 over points, and every point is $50, so that is, again, a dollar value, which is a currency. So when it comes to exposing you to generic examples on how trading works, I love to use currencies because of that reason. And later in the presentation, I'll be more specific with futures markets and other examples as well, okay? But let's start with the euro. So here's the euro US dollar, which is the most heavily traded currency in the world. You got the euro in one side, you got the US dollar in the other side. The US dollar is part of 80% of transactions worldwide. This, my friends, is probably the largest market in the world, okay? And what happened that day? Well, that day, that was January 4, okay? You can see we had a report coming out. That was the CPI, Consumer Price Index, okay? And you can see the prior number was 1.9. The consensus was 1.8, and the number that was reported at 10 a.m., that is GMT, okay, GMT time. So that number was 1.6, which is not only worse than the prior number, it's also worse than the expectation and the consensus, okay? So if we were to use common sense and we were to have an interpretation, what would you guess was going to happen to this market, okay? Well, probably you would think it's gonna fall. Okay, and what happens? Well, you can see the very opposite happened. It moved up, and not only it moved up, it was, I would say, a pretty powerful move to the upside. And most people will be like, why did that happen? Okay, how do you explain that? Okay, So again, a generic interpretation may have suggested that the euro would fall, but what if the large market players already had clues about that information and sold much earlier in a way where the news was already priced in? What if there were other indirect forces that motivated the large market players to buy the euro? Maybe there was another fundamental reason to buy the euro, and this news was an opportunity to get the euro a bit lower in price to buy more of the euro for a longer term move. So again, there is a lot of what ifs, there is a lot of interpretation, there is a lot of I don't know what I don't know, and relying exclusively in this case, a report could be problematic because if I ask you this question, and feel free to comment on the chat box, have you ever seen a good unemployment number and the market go up? Have you ever seen a good unemployment number and the market go down? Have you ever seen a bad unemployment number and the market go down? Have you ever seen a bad unemployment number and the market go up, right? And probably you have an answer for all of those 4 questions, which is yes for all of them, because this happens all the time. Many times we have a report and then we see the price action and we're like, this makes no sense. Sometimes we even say, the markets are crazy, right? And like we know better. This is, I guess, is being human. We all do it. I do it too, right? But the reality is that whatever happens, it's a true reaction made of on-field orders that got filled. Okay, so we need to dive a bit deeper into that. Okay, so therefore, let's go into the characteristics of direct forces and go back to that example to understand what really happened. Okay. So movement of price occurs when orders change status from on-field to field, no matter the reason why those orders enter the market in the first place. Having a way to identify those on-field orders before they get filled would allow a trader to capture market movements without any sort of subjectivity, since no interpretation would be needed. So if you know on-field orders are available at that price, no matter why price is getting to that particular buying price, you would be very happy buying, knowing that on-field orders to buy are available at this price point, because the moment you buy, you will have all these additional buying kicking in after you bought, and this would help the market to go up. For sure, in trading, there is never a sure thing. Orders in the market could be canceled. So as traders, we always manage the risk. We always use stops. We always have a contingency plan. We never trade like we're never going to be wrong. That would be a form of gambling, isn't it? So that's absolutely not what I'm suggesting. While the statement on this slide is powerful because it's 100% true, the reality is that the markets are a dynamic machine, and on-field orders, which have the power to move the market, could be canceled. True it is as well that the opposite could happen, which is on-field orders could be added. And then you have an even better trade, okay? And that's why later in the presentation, you will see how actually I'm going to combine the direct and the indirect forces together to execute trades in the same direction, okay? So now you add even more odds in your favor, as you will see, okay? Good. So small and large pockets of on-field orders are always available in the market, but only larger quantities of on-field orders produce the best moves. So how do we identify those on-field orders? Well, there are many techniques, okay? I see Mike pointing at level 2. Level 2 is a tricky one, as I was discussing earlier, because first of all, you will only see the orders that are closer to price. You will not see larger, if you wish, a stack of orders located at other price points which are further out. And on top of that, there is a lot of, this is not a technical term, but I'm going to use it anyway. There is a lot of trickiness, if you wish, when it comes to how institutions show their true size intention on the level 2 screen, as we discussed before. So there are other techniques on how to identify on-field orders. Of course, it requires the use of advanced trading technology, okay? I will show you how I do it myself. I use a tool called AutoUFOs. So now you know what UFOs stands for. There are other tools out there. You can even give it a try to do it manually, even though that's going to be a tough one, okay? Because obviously markets are dynamic. So these intelligent tools are constantly looking for traces suggesting that on-field orders are available in the marketplace. Scanning the markets like an X-ray machine would do is not an easy task, as lots of market data needs to be assessed simultaneously in order to spot subtle signs that reveal the potential existence of on-field orders. So now, key concept, subtle signs. So when we use tools that identify on-field orders, such as the ones I use myself, as you will see in a minute, it doesn't mean, it's not like the level to screen. Like in the level to screen, if you see an order with 20 contracts, that's an order. It's a real order that is there, which by the way, could be canceled. And then even though you see it, it's not there because it's gonna be canceled 1 second from now. So that's why it's tricky. But it's a real order at that time. That's my point. The tools that we're gonna use, okay, they don't show the real orders that are available at that time. And the reason why they don't is because we cannot know that. It's impossible to know for sure which is the price points and the quantities of contracts or shares that want to be traded by Goldman Sachs. The only way to know that is that you are a trader that trades for Goldman Sachs. So you are the one placing the order. That's the only way to know, right? So that's insider information, by the way. So therefore, what we're gonna do is we're gonna work around that by spotting subtle signs that reveal the existence of on-field orders, the potential existence of on-field orders. Why? Because when institutions act, it's a matter of size. While they use very powerful algos and very powerful techniques on how to enter and exit the market, in the end, it's a matter of size. Their size is going to be very large, even if they try to hide their true trade size intentions. And therefore, if you use technology that is smart enough, you will be able to spot those other signs. So in this case, you can see here, I'm talking about the bid prices, the ask prices, the last prices, volume data, tick data, time of the day, dates, time frames, and also a collection of ratios. So like for example, let's say a candle moved by that amount, but you got that amount of volume given the size of the move, but also you compare the amount of ticks that took place on the candle, given the volume, given the size of the move, given the time of the day. So again, all of those things and many more, which exceeds the purpose of today's lecture, would be some examples of spotting subtle signs that reveal large market player action and therefore potential existence of on-field orders, okay? And so you will see that in action in a minute, okay? So this type of process need to run real time as on-field orders can be added or subtracted from a market at any moment in time. And you need to be in tune with the changing dynamics of the market, okay? As a trader or even an investor long-term, what you cannot do is to place an order, okay? And or plan a trade today and just wait until 3 months later and take the trade then, because from now until 3 months later, many surrounding conditions may have changed, and therefore orders may have been canceled. So you need to revalidate things in a regular basis because markets are a dynamic machine. I wish the markets were to be like decades ago, where you can be very passive about it, but with computers trading since decades ago, it's a bit too hopeful, at least this is my experience and my own opinion, and again, what I've seen for years, it is a bit too hopeful to plan a trade today and 1 year later, still rely on that one trade and take it, and without double checking that everything that made you conclude that trade is valid is still valid, okay, because things are changing. So anyway, so let's go back with the concept of on-field orders in mind. Take a look at the same Euro chart that we had before, but now notice that we have the same report at 10 a.m. GMT, but notice that now I am activating here AutoUFOs, okay, which is the tool I told you I use. Of course, UFO stands for on-field orders, you know that. You can see here the cute little flying saucer right there, okay? So that little flying saucer represents the area between that UFO band. We call this a UFO band. This is the whole area where we expect on-field orders to be, okay? The area between the two green lines, okay? But that UFO there is the very, very location where we expect the greatest concentration of on-field orders to be, okay? So basically we expect price to come into the green area and anywhere inside the green area to turn and go in the opposite direction because of those on-field orders kicking in. But certainly in a perfect world, price would come all the way that low because if that was the case, instead of a slow turn like this, you would probably expect more like a V bottom type, something very aggressive like that. Okay, now, because we got on-field orders all the way in the whole price range, price may not necessarily come that deep on the first time. So it may need to do something like that, right? And then come back another time, and then the next time, then now he's gonna hit the UFO. Okay. So in other words, the whole price range is a trading area. Okay, it's a trading area for you to go long. And I'm gonna go over multiple examples. Okay, so this is a surface level explanation of AutoUFOs. I'll get a bit deeper into that. Okay, so now notice that going back to the same chart we explored earlier. Okay, where we said, how can that be? The news was bad and the euro went up. Okay, so notice what just happened. Okay, when the news was reported, the euro went down a little more. Okay, probably because the large market players took advantage of knowing the news slightly ahead of time, maybe just a few seconds, to place a very powerful shorting execution. Market went down, hit the on-field orders to buy, and then the euro turned and moved in the opposite direction very, very fast. And again, if I was to go back to the prior chart, which I won't, but if I was to go back to the prior chart, remember the question was, market is crazy. Why did the euro went up, right? So if you were to think of indirect forces only, you will be like, the market is crazy. Why did the euro go up? The CPI was a bad news. But if you were to be thinking in terms of direct forces, you would be thinking, well, of course it went up. There were on-field orders waiting to get filled. Price went down, hit those on-field orders. A lot of buy orders got kicked in. And of course, then euro had to react to that and move in the opposite direction. Okay. The Quana, the matrix, is level to data. Is exactly the same thing. Okay. It's exactly the same thing. Yeah. Yeah. I'll tell you more, Brian, on how you can get access to the UFOs and all of this. So who is who? Okay. If we were to categorize all the species found in nature in two groups, okay, and this is serious, but it's also using a little bit of humor, if you don't mind. So we could classify them being either predators or preys, where some preys could also become predators of other smaller preys. Isn't it the market? Okay, somehow, again, again, I'm using a little bit of humor here, but at the same time, it's serious stuff, right? So we can find similar circumstances in the market. And while it would not be possible to become a super predator, that's what we'd all love to be, right? That every time you click the button, you move the market yourself, that would be amazing. Well, the goal of the trader is really to never become the prey, okay? Never become the prey, okay? Sometimes you have small profits, sometimes you have bigger profits, but never become the prey, avoid being hurt. That's what we should do, right? So in other words, when buying and selling, it is key that we buy only when large market players are buying too. And when we sell, it is key that we sell when large market players are selling too. You don't want to buy and you are the only one buying. You don't want to sell and you are the only one selling. You need more people to buy after you buy. You need more people to sell after you sell. That's actually the only way to make money, isn't it? To have more people do the same thing you did after you did, okay? So most non-professional traders buy when everyone buys and sell when everyone sells without realizing they could become the prey, okay? So in order to identify the large market players, we simply need to find their on-field orders. We will not know, okay? I wish, okay? But let's be realistic. We will not know why their on-field orders are in the market. Maybe they know something we don't know. But as long as we identify their on-field orders, we will buy when they buy, or more or less at the same price. We will sell when they sell, or more or less at the same price. And therefore, we will be in a position where we avoid more often than not to become the prey. Okay? And then, of course, in case we are wrong, we will use stops and contingency measures. We never trade naked, guys. Never. Okay? That's gambling. That's not trading. So, influence of indirect forces. Despite the fact that on-field orders ultimately drive price movement, it is important to understand and be aware of the current market climate. Changes on the market environment, we call it the climate. Okay, on the Trading channel, we normally use the term climate. It refers to many things. I'll summarize it quickly here by saying market environment. And changes in the market environment may lead to on-field orders being added or removed. So this is especially true since the markets became electronically traded, meaning that millions of computers worldwide run processes that identify certain real-time conditions and will automatically place or cancel trades, speed of the light, automatically. Okay, so that's why you see, like for example, since 2008, 2009, I'm just picking one example, there are many more, but you see this amazing bull market that was non-stop going up for years and years and years. Why? Because, you know, I mean, there are multiple reasons for that, but computers just keep trading in the direction of the climate of the market, which is the market environment, which certainly could change, okay, and did change earlier in the year, but in the long haul, which is what I was discussing right now, it's certainly an up market, isn't it? So the use of advanced trading technology is critical to be objectively in sync with the market, with what the markets have to offer. So now, let's get into more powerful examples now, because up to this point, is there music playing? I don't think so. I don't think so. Yeah, I don't think it's on my end. Let's talk about combining forces, because we talked about the two forces, right? The direct force, the indirect force. They are all important. Of course, you can see my passion relies on the direct forces. I think it's common sense. Hopefully it makes sense to everybody. But at the same time, we said the indirect forces are still very relevant. So in a perfect world, what you would want to do is to combine them both. If you were to combine them both, you would add more odds in your favor. Okay, you would add more odds in your favor. So let's take a look at how we're gonna do that. I'm back to the example from January 4, okay, where the CPI was reported for the euro. And this is the last time I'm gonna go through this example, okay? And then I got more examples for us to look at it. But take a look at what it says here. It says, in order to combine the forces, which is the report and the UFOs, okay, probably the best decision, okay, and that would be the way to approach it really, is to do nothing. Let the news to be reported, do nothing, and instead wait to see the evidence of new on-field orders entering the market. Why? Because seeing on-field orders entering the market, red color UFOs are gonna be sell orders. Green color UFOs are gonna be buy orders. So if after the news is reported, you get to see UFOs forming on the chart, so that would reveal what the interpretation of the large market players has been. Instead of you having a guess, which is, oh, to me, this is a very bad news, the market is gonna fall, everybody's thinking the market is gonna fall, I'm gonna sell. Or to you, it's gonna be like, oh, to me, this news was unexpected, but somehow someone may have known, so the news may be built in the price, and I'm gonna be a contrarian and be a buyer. So again, all of these would be valid at times and invalid at times, and it's all about the interpretation. So instead, my proposal to you is forget about the interpretation. Instead, okay, wait for the UFOs to form. So notice that this is the 60-minute time frame of the euro, the same chart we saw before, okay, and I'm using the same chart 3 times. So this example is well understood beginning to the end, and now I'm gonna move into other examples. And notice that here, you remember we got on-field orders, right? So price came in, and from there, price bounced. So earlier I told you that buying here would not be a crazy thing to be done. It would not be a crazy thing to be done. Actually, it would make sense. And it's not a surprise to see the price moving out to the upside out of that UFO price range. Not a strange thing, okay? But it's not a safe trade to execute that trade. Why not? Because if the news was to be powerful enough, if the indirect force was to be powerful enough, those on-field orders could be canceled. And yes, the app will pick up on that and remove the UFO from the screen if that's the case. But again, we need to spot subtle signs first. Okay, the technology takes a little bit of time to process data, and it may we may realize that, or we may not. And also, what happens is that we are human. So what I said, we should be observing the markets and review the markets on a regular basis. Well, maybe you had this trade analyzed 2 hours ago, and maybe you trade while you're at work, and maybe you review your trades every 2 hours, and guess what? The news happened in that window of time, and you didn't have time to review, and now you got stopped out. So what would be a safer way to do it? A safer way to do it would be to do nothing here, okay? Do nothing, as it says, okay? We do nothing. And what do? Instead, we wait for the evidence of new on-field orders entering the market, which is that UFO on the top, on the right. That UFO was not there before. It's happening after the news is reported. So what is that telling you? Well, buy on-field orders are added to the market. So what interpretation large market players had? Well, their interpretation, it's positive. So what would you want to do? knowing that the indirect force is setting a market condition to be a buyer, and knowing that you got on-field orders available at this price point, which is around 114.14, what would you want to do? You will want to wait for price to return into the UFO and now buy, expecting the market to continue going higher. Why? Because you have the on-field orders, but also the market climate is prone to that. Okay, so you have direct and indirect force working together now. So what did just happen? Well, this is 114.14 more or less. Okay, it's a bit lower, 114.11 or something like that. So price went all the way there, hit the UFO. Okay, and from there price started moving higher. So that was a beautiful trade. Now let's say you missed that one. Well, after you got another UFO form a bit higher, around 114.45 or something like that. So what would you do? You could plan a second trade later on and just keep trading in the direction of the market condition while you have evidence of on-field orders, so you know what is your buying price. Same thing for the selling price for the targets, okay, which I'm not discussing here in this case, okay? But you would do the same thing for the targets, okay? It is definitely nice for trend trading, for sure, okay? Absolutely. Now, next month, okay? Next month. So the prior example was January 4. So now we are dealing with February 1st. Same news is about to be reported. The CPI is reported once a month, beginning of the month. So what happened that time? Well, at that time, the news was a green number, okay? So what do? Same story, nothing, do nothing, wait for the UFOs to form. And what just happened after the news is reported, which in this case was a green number, right? So what happened? A red UFO form. So even though the reported number is green color, doesn't matter to us. The UFO is red color. So we now know that the interpretation of the news is actually negative. And therefore we expect the euro to continue falling because this market condition, okay, this market environment, and most importantly, the on-field orders entering the market as a consequence of that particular piece of information, it's likely going to bring the euro down, okay? So what would you want to do? You would want to be a seller, okay? And this, again, this is a euro. It could be a stock, it could be futures, it could be gold, it could be oil, you name it, right? So when price would come back to the red UFO, you would expect the prices to continue falling until the green UFO, good place to take a profit, okay? So anyway, so a smart action would be to wait for the price to return and take a trade around 114.55, okay? And this is the place where the shorting opportunity was taken, nice profit was made on the way down. Let's say you missed it, you were not in front of your computer at that time, no worries, do the same later on. New UFO form afterwards, you have the market condition, you have the UFOs, you can put together those two on-field orders, have them team up for us as traders, and catch trades that have a greater probability of profit in this case. Okay, by the way, price came to the green UFO, that green UFO right there, and the moment price touched the UFO, turn in the opposite direction. Of course, not a surprise, buy on-field orders. That's why I said good place where to take a profit if you shorted at this upper price point, okay? So anyway, now, up to this point, I've been talking about indirect forces, direct forces, and everything was about the news. I would like to change direction now and talk about other types of indirect forces. For example, moving averages. Moving averages are technical indicators that are regularly used by fund managers that want to add more to a position, and therefore they tend to act as an indirect force that often adds new on-field orders to a market. So let me show you this. Let me zoom in so I can explain that better. So notice, okay, that there are many times you may see, it's a bit difficult to see to be honest, but price here went down, 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 down. There is a wick, and from there price move up. Okay, so the moving average, which is the blue line, okay, acted as a dynamic support, okay, and created that mini bounce. Then price went on the other side of the moving average, and when price rallied and hit the line, it went back down. Price rally, hit the line, went back down. My lines are a bit too thick, as you can see, okay. And again, at this point, the moving average acted a little bit as a support, Okay, then price went above, okay, and then here there is a little bit of, zigzag. So here nothing was too relevant, but here you can see again one more time, price touches the moving average and bounces. So that was another dynamic support. Then price went through, okay, and after going through, price came to the average right here, and from there failed, then came to the average right here, right, and from there failed. So again, those price points, the moving average is acting as a dynamic resistance, okay? And it doesn't matter, to be honest, Jose, if it's an EMA or a simple moving average. In this case, it's an EMA, it's an exponential one. But the concept of a moving average really is the same. Even if you change the period, you will see the same type of price action. And the reason why you have these bounces, okay, like here, for example, price went to the average and bounced. So the reason why is because fund managers are using them, okay? So fund managers receive funds to manage every day, and they need to get people invested. And they're trading other people's money, it's not their money. So as long as they enter the market at a fair price, that's good enough for the fund. So a fair price is an average, and you will see many bounces like that. Now, while you will see many bounces like that, you will also see many cases where price went through, like the average is not there. Why? Because the funds and the fund managers may act on the average or may not act on the average. So again, it's like the news. The news is reported, the interpretation may be positive, may be negative. So you have a maybe situation. The moving average is a maybe situation. It may bounce, it may not bounce, right? So it's an indirect force. It may help you, it may not help you. It's an indirect force. But what do we have here? Okay, so I would like you to focus on what's happening right now. So right now, we have an average right here. That's the blue line. But what's the beauty of this blue line? Well, this blue line is being enveloped by that UFO price range. What does that mean? Let me explain that setup in words. The blue EMA line represents a price point at which on-field orders to buy may be added. It's a maybe situation. It's better than nothing, but it's just a maybe. Okay? So the blue line represents a place where on-field orders may be added. But we have the UFO, and the UFO represents a place on the chart where on-field orders are identified. So in other words, on-field orders are already present at this price point, plus we may have a few more added thanks to the EMA. So what do we have? A direct force working together with an indirect force. Now, in this case, it's not news. It's all technical because it's a moving average, it's a technical tool, together with the UFOs, which obviously is also a technical tool. So if you look at what happened there, okay, beautiful move, okay, nice move. But let me zoom in. Okay, let me zoom in. If you were to be looking at this chart and you didn't know anything about UFOs, you would be like, wow, the moving average there was amazing. Okay, but what was the key? The key was on the left. The EMA was lining up with the UFO band. Okay, so what did push the price up? Was it the UFOs or was it the EMA? I don't know. Maybe the UFOs got canceled, but the EMA added new UFOs. Maybe the EMA did nothing, and the UFOs that were in the market already at that price point did the whole job, right? Maybe it's a combination of both. I don't know what it is, but certainly I think it's common sense to say that by putting the two together, they help each other to produce a higher quality, higher probability trade, isn't it? Take care, Gerson. Good to see you. So now, there are more examples, okay? But I would like to show you as well trades with other markets, okay? So now we are looking at the Dow futures, okay? And this is a trade, you can see me here on the right, isn't it? So this is a trade I plan on the Traditive channel with You Can Trade. And this is the YM, this is the Dow futures. So notice that we were planning on a long trade here. We're using an entry, a stop, we always use stops, safety target for safety purposes, and then a final target, okay? And so notice that the entry was that UFO, okay? That was the entry, okay? That was the entry. So we were relying on that, right? So now, what did happen to this trade? So I'm gonna animate it, okay? So it's gonna be a bit more visual for you guys. So we took the trade, okay? And notice that this is accelerated, by the way, so we can see this more easily during the presentation, okay? But the trade was executed at this price point, okay? On-field orders to sell came in, okay? But let me pause this, important, okay? Because I'll give you access to this tool later at the end of the presentation. So Auto Climate, which is the tool I have here in the bottom part, was telling me about the climate. The climate was blue, okay? So those on-field orders to sell were likely going to be canceled because the climate was up, okay? In an up climate, buy on-field orders tend to be added, okay? Oh, sorry guys, I just went a bit too far there. I just clicked in the wrong place in the slide. So anyway, so we went into the trade. The price started moving, okay? And notice, remember, in an up climate, buy on-field orders tend to be added, okay? So watch carefully, because as we are in this trade, okay? And this is the challenge of trading, right? You have to watch it, you have to be patient. That's why it's important to be coached. Okay, we do this together in the channel, guys. So price was moving up, so we hit our safety target. So this trade was a trade with no risk. And notice what just happened there. A new green UFO just happened, okay? A new green UFO just happened, meaning that on-field orders are being added. And notice what I just did. I am trailing my stop, putting my stop below the new UFOs that are forming to just follow price, maximize my profits as the market develop, in case the market climate was to change, because another news, another market condition takes place out there. Markets are dynamic, anything could change. Notice another UFO just formed. So again, stop trailed again, etc., etc. Okay, so this is how you manage the trades. This is how you trade, and this is how you stack odds in your favor by combining direct and indirect forces. Okay. Now, this not always works. Okay, it's not the case. Okay, sometimes we get stopped out. Okay, and I want to show you a case of that too, guys. Okay, because while this is exciting and we love to see the golden color kick in, isn't it? Because it's the color of profits. Well, the reality is that there are times where you know, it's not the case. There are times we get stopped out. Okay, so let me show you cases where it did not work. Okay, so we plan the trade using the UFOs. Okay, this is the Russell futures. Okay, different market but similar setup. So notice in this case, I got into the trade. Okay, I got into the trade. This is the plan. Russell long. Okay, so the order is in. Okay, and so we got into the trade here. That's another day. Those are trades that we're running the channel again. By the way, all of you can attend the channel. There is a trial period of 14 days for all of you guys. So feel free to join us, guys. It would be a pleasure to meet you in our channel sessions as well. So notice how the market, in that case, is showing us now negative $140. Okay, so this is a trade that didn't work well. But again, we are using contingency measures. So what I'm doing here on the left side of the screen with this 2-minute chart on the left is I'm working on what we call a time stop. Okay, so the market is doing its thing, it's moving against me. Notice how I'm looking at the time, and notice how I'm clicking the close button there to exit this trade manually. I was risking $250 in this trade. I ended up exiting this trade. I think it was $100 something of loss, which obviously is not ideal, but it happens, and it's important that we do this right, okay? We trade everything, Mike, okay? And index futures, of course, it's a common market because there are some of the most liquid markets in the world, but we also trade oil, corn, gold, treasuries, 10-year note, US 30-year bonds. We trade everything, okay? Our channel is about trading everything. Also, the UFOs is something you could use as well for non-directional trading, for the ones as well as out there doing options trading. Notice here, we got a red UFO here on the top. Okay, so two red UFOs above, multiple green UFOs below, the bottom one is there. So with the purple lines, okay, this purple line above and below sets a range, okay, and in this case, for the ones of you that know options, we set up an iron condor on that day, expecting the price to stay in the purple area from that date to that date that was the expiration date of the condor. And notice that on that date, okay, so the price had done price movement within the purple range, and on that date, okay, which is the expiration date, we were still inside the purple range, so that iron condor was profitable. This is non-directional trading, okay? This is options trading. For the ones of you that know options, you know exactly what I'm talking about. So anyway, we are the Tradictive channel. I mentioned the Tradictive channel a few times in the presentation. So what is the Tradictive channel? It's a place where traders and investors develop their skills using quality education pairs with powerful coaching and enhanced by the use of innovative and easy to use trading technology that helps mitigate the challenges attached to today's busy lives, as well as the impact of trading emotions, okay? 2 promotions to get you started. I mentioned one already, 14-day trial. So join us in the channel, spend some time with us. You'll have fun, you'll learn a lot. And if you like it, you can stick with us afterwards. And if you don't, there is no commitments. So no worries, join us. And then also we run courses apart from coaching, and You Can Trade is running a very nice promotion where if you purchase one course, you get another course for free, okay? So take a look at that. You can check the website, youcantrade.com/channels/tradictive. And when it comes to time for trading, Georgia, good question. I'm going to show you that in the next slide. So on the channel, we like to think of ourselves as multi, okay? Multi-asset, multi-style. We trade all markets, futures, options on futures, cryptos, stocks, ETFs, for short-term traders, for long-term traders. So you will see our schedule is quite, intense. We are multiple coaches. I'm one of them, but we're a team of coaches. We have a support team as well. We do sessions morning hours US, afternoon hours US. We also do pre-market overview, as well as after hours review. Multi-courses live as well as on demand. We send our trades in SMS format. So if you miss the session, you still get the SMS and you can still execute the trades. Of course, we recommend you to attend the session. So when you receive an SMS, you know what you just got on your hands. Don't just copy the trade blindly just for the sake of copying the trade. Let's be serious, okay? So a week with You Can Trade, it looks like that, okay? So 8 a.m. New York time, we do the overviews. 9 a.m. we do our active trading. 1 p.m. we do options investing. And then at 4:15 p.m., all of this is New York time, we do our after hours review. On the weekend, we do sharpening. The markets are closed, so no need to rush. Therefore, we can take our time to go over what we call reinforce and very important trading psychology. So pre-market trading sessions, after our review. Monday, Wednesday, and Friday is what we call the active days. Tuesdays and Thursdays are what we call the less active days, okay? And this is how it looks like if you look at a whole month in You Can Trade. You have the pre-market overview and the after-hour review with the light blue. The blue sessions are the trading sessions, okay? 9 a.m. and 1 p.m., including the weekends. And then the ones that are colored are our live courses. We run futures, stocks, backtesting, building your trading plan, and your trading psychology, okay? We are running the stock course right now from 8 to 14 of August, as you can see. The next one in line is trading psychology, and the one after is futures. The instructor that will conduct the futures class, her name is Louise Carr. She has a special coupon code with Louise on 822. If you were to register for that course using her coupon code, thanks to her, you get a 20% off of the course. So you can just get into the You Can Trade website and you'll be able to see all the details about the course and so on. Same with Becky when it comes to backtesting your plan or building your trading plan. Becky also has a coupon code with Becky on 926 or with Becky on 829, which is the dates of those courses themselves, okay? So I said I would have a gift for you guys. AutoClimate, this is one of the tools I briefly mentioned in the presentation. This is an app that aims to assist you to identify if it's time to trade or not. And if it's time to trade, should you go long or should you go short, okay? This could be your indirect force identifier, if you wish, and then pair it together with AutoUFOs, and you're good to go, okay? So how do you activate your gift? You just need to use the URL tradictive.com/aclimate, okay? Tradictive.com/aclimate. And you will get to this screen, okay? You click install. The moment you click install, the app becomes active in TradeStation like a native function. So you just need to click install, log out of TradeStation, log back in, and magic, AutoClimate is there. Same for AutoUFOs, even though AutoUFOs is a subscription tool, so you will be able to see it as well on that web page, and you can also read more about the characteristics and so on. You can download the user guide. You can see more data, okay? We have conducted webinars before to talk about it, so you can also watch prior recordings, okay? And someone was asking about performance. I will show you that after we end the session, okay? So guys, a little bit of a summary of items that we discussed. Download your AutoClimate. This is Daniel is 9.5 and 10.0 both, so you can use it for any version of TrustStation. So get your AutoClimate, is free. Come and join us in the channel. It's free for 14 days. I'm pretty sure you'll have fun, and we'll certainly be delighted to have you with us and be exposed to different markets. And then if you need further formal training and attend like a proper training course, know that there are multiple courses that we run in You Can Trade. And both Luis and Becky have been kind enough to put together coupon codes where you can get those courses at a discounted rate. So that's nice. So maybe it's a good idea if you want to take a screenshot of this page, okay? So guys, if there is any additional question, I think as the session was progressing, I was looking at your questions, and I believe I should have answered everything. I surpassed the ending time of the webinar by 5 minutes, so we'll have to conclude it quickly. But certainly, if you have any additional question, please type it in, and I will be delighted to take a look. I want to answer one last question, which I haven't, which is the performance of the UFO. So I want to show you that on the chart. Thank you so much, Mike. Yeah. That's very kind of you guys. Very, very kind of you. Thank you so much. Okay, so let me show you this very quick. So so here's TrustStation. Okay, here's TrustStation. So for example, let's say you tell me that you want to apply AutoUFOs to the S&P 500 futures. Okay, and let's say you tell me that when you trade S&P 500 futures, you trade the 5-minute time frame. Okay, so this is the 5-minute time frame of the S&P. Notice is automatically speed of the light identifying the on-field orders for you, buy and sell, red and green, right? So the question is, what about performance? So UFO got something built in called calibration. Okay, so depending on your trading style, and this is explained in the user guide, by the way, so you can download it, or you can send us an email as well. You know, tradictive@youcantrade.com, and we'll be happy to lead you into that. But apart from your calibrations, okay, which are to adapt the tool to your trading style, meaning are you very conservative, are you more aggressive, do you want more UFOs, less UFOs, you want the UFOs to be pickier, more selective or less selective, depending if you are very conservative or less conservative. So what you could do on top of that is go ahead and activate stats. And if you activate stats, here you get performance metrics, which is the blue value. Let me move it out. Here we go. This blue value, which in this case is 67, 65, is telling you how often those UFOs work well, okay? So again, each market is different. And the beauty is that if you never traded, let's say you never traded crude oil, and you're like, okay, I've traded the S&P, I know it's 67%, you know, I got this performance on my charts. So what about crude oil? I never traded crude oil. What should I expect? Okay, so I'm loading crude oil, and now that I load crude oil is 66, 97%. What? Oh, I never traded gold. What if I do it with gold? Okay, so now you load gold, and now it's going to tell you 56%. Oh, wait a minute, gold is not so good to be trading the 5-minute. What if I was to use the 15-minute? Okay, well, 15-minute gives me 62%. That's good enough. Let's go for it. So again, we don't have much more time, and we have recorded sessions that talk about the UFOs properly, but I thought of at least displaying this feature and for you to understand all of this, okay? And you could certainly apply this to any time frame. Maybe you are a bit longer term, you use the 240-minute time frame on gold, okay? And here's still pending data, so I need to wait a little bit for the data to be downloaded. And this will show in a second, okay? So we'll just wait. Quick look at the last questions. Oh, Ruth, thank you very much for your comment to Becky. I will let her know. She'll be very, very, very happy. She's amazing, isn't it? Okay, so we got 240-minute time frame of gold, 62% is the performance that you get there. Yeah. This is, Scott, this is a presentation. Yes, that is obviously related to TrustStation. Okay, for you guys that may not use TrustStation, we also have this technology available in TradingView. So I don't have time to address it in the presentation. I just surpassed the ending time by way too much. So I'm going to conclude it here. But please send us an email. We'll be very, very happy to give you a solution. So predictive@youcantrade.com. Okay, and for the ones of you out there using any other platform which is not TradeStation, so we have a solution which is universal, to be applied. So send us an email, and again, more than happy to be in touch, and hopefully we'll see you in the channel, guys. It's been my pleasure, my real pleasure to conduct the session today, to guide you. Hopefully today was eye-opener for the ones of you that never heard of on-field orders, order flow, and all of this. See you soon, my friends. See you in the next one. And we have another presentation with my team later in the month, where we'll be talking about other aspects of trading. Becky will be conducting the presentation. So Ruth, I'm pretty sure you'll be happy to get a bit more time with Becky, and everyone else. If you haven't met her, I recommend you not to miss it, because it's going to be powerful. You guys take care. See you soon, everyone. Take care.